Good morning, everybody. Allie Peters over here. I hope everyone's had their coffee. We're going to get started here pretty quickly. We want to stay on time and we want to respect your time. We are so fortunate today. We have Mike on the line. He's our annuity specialist over at Protective, going on 13 years, I think he said over there. So we are really happy to have him as a partner, and we want to teach you all about this new product from Protective, the Guaranteed Income Indexed Annuity. We should be able to stay in that 30-minute window. We might go a few minutes over. If you have any questions, you can type them in as we go, and I will make sure that we get to them at the end. I also will be putting a recording of this on our website, as I always do, with the presentation as well. So if you need to go back, and as always, you can call Alan Bradley and connect with him if you have a specific case you'd like to check out and see how it runs. So without further ado, Mike, would you like to get started?
Yeah, sure would. Thank you very much, Allie. I sure appreciate it. Thanks everyone for attending. Sure appreciate the opportunity Core Group's given me. We've worked together for quite a long time, and I'm very happy to be talking to you about this new product that Protective Life is introducing into the independent agent space. So this product is built specifically for the independent agent distribution. That's new for our company. In the past, we focused on bank and broker-dealer distribution. This product can only be sold by what we would call BGAs. So for us, that's a change and a step into this market, and we're very happy to be working with everyone. And with that, we'll launch in. Real quick, a little rundown on the annuity suitability requirements. Your attendance to this webinar will count as your product training. So we'll run through this real quick, and then we'll get right to the rider. So want to make sure that the purpose of this training is to learn the product well. Your obligations are to make reasonable efforts to obtain the consumer's suitability information, retain accurate client records that support your recommendation, understand the client's current financial situations and objectives, maintain a comprehensive knowledge of the annuity products you recommend, and stay current with any material product changes. Recommend products based solely on the client's best interest without regard to your financial personal interests or those of your firm. Educate the client on the advantages and disadvantages of any recommended products, and describe how the client's needs and objectives are being addressed. Stay current on all relevant legal and regulatory developments. Be aware of and adhere to regulatory requirements about annuity illustrations, and manage your practice with a focus on compliance. So that's the purpose of the training requirement, and we'll get right into it. So the Protective Guaranteed Income Indexed Annuity. It is what we're calling it. It's a indexed annuity with a guaranteed income rider. It's called the Guaranteed Income Benefit. So before I get into the details here, I want to talk a little bit just kind of broadly. So the title of the presentation is How to Maximize Income at Age 70, Even When Life Happens. So I'll talk about where we position ourselves at that age. We're strong on income at age 70. And I think equally as important is even when life happens. So how many of you, I'm sure if we were all in a room, you'd be able to raise your hands. How many of you have had a client, you make a nice plan and then the client doesn't stick with the plan? Or conversely, they want to stick with the plan and something in their life changes that they have no control over. Possibly a death, a divorce, or a marriage, either direction of that. So those things are material. They affect your planning, the products that you use to meet those needs and the benefits that they have. It's important that, in my opinion, that those be flexible. And we're going to focus, I think, on some unique flexibility in our product and how it can help you during that deferral time while you have the benefit base of this product growing and be able to deal with changes as they come up, both as a client and as an agent. So the Guaranteed Income Benefit Rider, it isn't simple interest roll up on this for up to 15 years. So we did build this product generally for deferral on the rider. We have some spots where we're strong on income right away, but also we've built it so that it's strong on deferral. We do have benefit-based credits, bonuses at years 5 and 10, and I'll describe those. And it is eligible for step-ups until age 95. And then also part of the rider, one of the options is rising or level income. And this is one of the most important flexible points that we have in the product, in my opinion. The owner chooses whether they want rising or level income at the time they turn the income on, not at the time that they sign the initial paperwork. This is a critical difference in our product. So as we're thinking about the situation, 10 years ago, you had customers, let's say they were 50 years old, focusing on accumulation. They're trying to grow their nest egg. Those customers here 10 years later, they're approaching age 60. And what are they starting to think about? What are your concerns now? Typically, the most concerns that folks have these days are their fixed income portfolios. And your clients are starting to consider how they're going to generate a lifetime income. So with that, do you want to have to choose, think about a customer, do you want to have to choose single or joint income at age 60 when they may not be taking that income for another 10 years? Or would you prefer to make that choice at the time that they turn the income on? Perhaps they've lost their partner, perhaps they've divorced or become married. Those are life-changing events, and this product will help accommodate those. So you have a product with levers in it and with options in it that are very beneficial to the customer. We also have a rising income option. We have both a level and rising. Same flexibility with that. You don't choose the rising or level until you turn the income on. Generally, that's going to be after some deferral, and in that time, you may have some life changes. The level income is banded based on age, and we'll talk about that. The product availability, issue ages 50 to 79. We decided that if someone's not using this kind of product by the time they're age 80, it's probably not suitable for them. So we did make the age band 50 to 79. One thing to note about that, as an aside, there is no commission reduction in that age. So 50 to 79, it's all the same commission. Minimum investment is $25,000. And then if they choose to, they can turn income on as early as age 59 and a half. So we'll get through some kind of details on the rider, and then we'll see an example of how the benefit-based roll-up works. So again, issue age is 50 to 79. The cost of the rider is 1%, and that does drive off the benefit base. It is a 4% simple interest benefit base. We'll talk about that. It may sound a little bit low, but at the same time, it's a much lower fee drag on the product. Since we have bonuses in this, in those in-between years, you got a lower fee drag on the account value of the contract due to the lower simple interest crediting. And you can do that for up to 15 years or until you turn the income on. There are step-ups available. That's another actual advantage of the 4% simple. You have a much better chance of getting a step-up on performance in this product based on that. And then there are two guaranteed income options, as I've mentioned, level income option and a rising income option. Again, you make that choice when you turn the income on. You can certainly do joint income that is reduced by 50 basis points based on the withdrawal rates we're going to show you. A joint income will be reduced by 50. So let's do a quick example of how this roll-up works. We're going to assume a $100,000 premium, and we're going to assume the full 15 years of deferral before they turn the income on. So you see the 4% simple roll-ups, adding 4% each year. In year 10, we have in year 5, we have a 10% benefit-based bonus, and it is based on the net premium in the product. So in this case, that's going to be a $10,000 benefit-based bonus. At the end of 5 years, that gets you to a benefit base, assuming no step-ups, of $130,000. So I want to make a point here. So we've got a 4% simple roll-up, but at the end of 5 years with that bonus, we've got a $130,000 benefit base. Effectively, that's a 6% benefit-based roll-up, halfway through the life of this surrender charge period. Let's do this for another 5 years. You get your 4%, your $4,000 benefit-based bonuses. In year 10, we have a 30% benefit-based bonus, and that gets you to $180,000 at the end of 10 years. So we've got a product with a 4% simple roll-up, which does result in a lower fee drag on the product, but with the benefit-based bonuses that we have at 5 and 10 years, at the end of 10 years, you effectively have an 8% simple roll-up. And should they choose, the client can also defer this another 5 years for the full 15, at which point the benefit base has doubled. Again, this is assuming no benefit-based step-ups during that time. So that's a quick little recap of how the roll-up works. Alan Bradley can go through that in detail with you if you have a case you want to talk about. But I want to make sure that we highlight, although this may sound low, effectively at 5 years you've got a 6% roll-up. Effectively at 10 years, if you defer, you've got an 8% roll-up. So don't let the 4% simple fool you. So we'll look at some of the withdrawal rates. Where we're going to be strong, although we are shooting at deferral on this product so you can grow that benefit base, we can also be strong at income now. So if you start this product on a level option at age 65, buy it at 65, turn around immediately. We've got a 4 1/4 benefit-based distribution. I know that's competitive at age 70. At age 70, that's 6%. So if you purchase this product at age 70, turn on income right away on a single life, you've got a 6% level distribution. So think about some of the customers you may have. Perhaps they have old products with lower distribution rates or that maybe haven't performed well. If you think you have clients in your book who would benefit from a product where you can purchase it at age 70, turn the income right away, and have a 6% withdrawal rate for life, I think that's got some flexibility in it for you. We'll see the rest of the these are the level banded withdrawal rates, and it does go, if they turn it on at age 90, it does go as high as 7.5. This is the rising withdrawal rates. So we've got a kind of a full schedule here. What I want to point out about this is how it works. The rising withdrawal rates, this is a guaranteed increase. This increase in income, it is not based on performance in the product. You may get good performance and benefit from that and have a little higher account value, but you're not depending on it for the guaranteed income. And so the way it works, when you turn this income on, let's say you start at 65, your initial distribution rate that first year is 4.5. Each year after that, as long as you have an account value, that distribution rate is going to go up by 10 basis points. So year 2, 4.6, year 3, 4.7. Next thing you know, at age 70, you're at a 5%. This will continue to increase 10 basis points every year until the account value is drawn down to 0. At that point, we don't revert to a lower income. At that point, when the account value goes to 0, that becomes a guaranteed lifetime income of the contract. So I want to stress that. We are not counting on performance that may or may not happen. We have a guaranteed rise in income that will rise as long as there is an account value in the contract. Combine that with not having to choose this option until they turn the income on. I think you have some flexibility that'll help both you and your clients. Let's say you purchase one of these contracts and you've locked into a joint distribution when you buy it. At a later date, either there's a divorce or perhaps someone has passed. By the way, the average age of a widow is lower than you might think. Average age of a widow is 59. So right in the wheelhouse of where this product is suitable for people, you start having to deal with the possibility of one of the spouses passing. This product gives you flexibility to deal with that. You're not locked into a joint payout, and you're not locked into a level payout. So if that were to happen, perhaps looking at a rising income option would become more viable if you're working with a single life, someone with lower expenses. Interest crediting strategies, we'll cover this kind of quickly in the rest of the chassis. We do have a fixed interest bucket. That's an annual reset on that. We have an annual point-to-point with a cap, participation rate with a cap. Annual point-to-point with a cap, and that's based on the S&P 500. And then we do have a 2-year participation rate in a index that's been developed for us by Citi, and that's a 2-year point-to-point, a volatility-controlled index that I'll talk about here in just a second. So we're keeping it pretty straightforward. We've got a fixed and annual point-to-point, and then a 2-year participation rate growing the account value. Remember, at the same time, the benefit base is guaranteed to grow until you turn the income on. So we'll talk quickly about the Citi index. It is a flexible allocation, volatility-controlled index. They do monthly allocations between a core portfolio or a reserve portfolio, and that's based on their risk aversion indicator that they built into the product. One of the really nice things about this index is they use a nice blend of equity index that they look at. You have large cap, mid cap, and small cap. You have some international index that they look at, and emerging markets, as well as commodities. That's in the core portfolio. In the reserve portfolio, where the funds may be moved if their risk aversion indicator is rising, The reserve portfolio is 25% in gold and 75% in treasuries. So the flight to safety is gold and treasuries, and I think the gold exposure is something that's kind of unique to our product. 6% is the volatility target, and again, that mechanism, it's a monthly review that they do, and they move between the core and the portfolio and the reserve portfolios to manage that volatility in the index. So this being NAIC product training, we're going to do some simple explanations here. Got an illustration about how a annual point-to-point works. We do have a cap in the first line. Let's say that the index performs very well, and you have a 4.7% cap. You would credit the 4.7%. Year 2, same issue. Year 3, let's say you have a lower performance below the cap. In this case, we would credit 1.2%. Of course, one of the main benefits of these products is in a down year, there is no loss for the client. So to that point, you've got folks out there who've had a great run at accumulating funds. They've had a great 9-year bull run. At this point, do they want to keep renting their gains, or do they want to maybe own those gains and possibly reposition some of their portfolio into a protected product where they cannot lose money, where they have the option of gains in the contract and also a guaranteed income? So, of course, the traditional benefit of the index annuity. Here we've got a quick, in that 2-year point-to-point, that does have a participation rate. Currently, for 100,000 or more, the 2-year point-to-point participation rate is 120%. In this example, it shows you both a 93%, shows you a 93% participation rate and how that math works out. I'm sure we're all familiar with those. So some about the chassis here. So that it's not a registered product. The free look provision, that is determined by state law. Issue ages, as I said, ages 50 to 79. Contract ownership, we can have single or joint ownership. One thing to remember is in our products, we do have a single annuitant during deferral. When you go to turn the income on, or should someone choose to annuitize, at that point, certainly they could do a joint annuitization. And our contracts are owner-driven. This product, it's approved in all states except New York. As I said, the minimum initial premium, $25,000, maximum $1 million without home office approval. Minimum addition is $1,000. Maximum, of course, is $1 million. And then one thing about additions, we take them only in the first contract year. After the first contract year, no additions to the contract. So I'm going through this part relatively quickly. These are items that I'm required to cover. Want to make sure that we get these covered, and then I'll finish up with a few more observations about the rider. So the non-forfeiture interest rate. We've recently increased it on our products from 1 to 1.25%. One nice thing about this, one benefit is that's 1.25% compounded annually on 100% of your premium. And what we found is, what that does when you do that math, the guaranteed minimum surrender value on this product at 4 years and 7 months gets you right back about to where your initial premium was. So we've got a 10-year surrender charge product with that 1.25% on 100% of your premium at 4 years and 7 months. Despite surrender charges, you are looking, should a client change their mind, choose not to use the rider, they would be able to walk away with their premium at 4 years and 7 months on a 10-year product. Again, a very, very beneficial, flexible option in this product. Of course, it's not what it's built for. It's not how we sell it. But again, as we know, things change. People change their minds. And we've had recent example of that with tax law changes. So what if you've got one of these products, suddenly someone is, their taxes have gone down, they're maybe having some better investment returns than they expected, and they choose to reposition this asset 4 or 5 years into the product. With ours, with that favorable non-forfeiture rate and the 100% of the purchase payment, they were able to do that less than 5 years into the contract. Again, I think a consumer-friendly way that Protective Life builds their products. So interest rate banding, we do have rates are banded on less than 100 or 100,000 or more. And then we do, as I said, we've got the 1-year fixed interest or the annual point-to-point, the traditional point-to-point with the cap, and then we've got the 2-year participation rate strategy in the city. The indexes that we use, as I said, the S&P 500 for the point-to-point cap, and then the city flexible allocation 6 for the 2-year point-to-point. And here's a summary at the bottom here: fixed interest crediting, annual point-to-point, and then the 2-year participation focus. As I said, here's the withdrawal schedule. It is a 10-year schedule. It does vary slightly in California. And then withdrawals that we do, should a customer choose to take any withdrawals, we have what's called a holding account. That account is for anything that doesn't qualify as an initial premium. So in addition into the contract, it stays in the first contract year, it stays in the holding account, and then it's applied to the crediting strategies on the first policy anniversary. Should they choose to pull money out of this contract, it'll come out of the holding account first. That holding account is credited 1% while it's in the holding account, and funds will come out of that first should they choose to exercise or need to exercise their 10% penalty-free distribution. That does begin in year 1, by the way. So year 1, right away, should something change or should clients just need the money, they can get 10% of the account value up to, in year 1, it'd be 10% of the premium, and that does begin in year 1. It's got a market value adjustment on it. It is limited. The limitation on it is the market value adjustment amount. It will not exceed what the non-forfeiture interest rate in the contract would be. So it will not exceed more than 1.25% of the contract, of the interest that's earned in the contract over and above that. Withdrawal charge waivers, we've got a nursing home, terminal illness, and unemployment. Unemployment waivers are unusual. And then another unique thing, another customer value and benefit in this product, on our nursing home and terminal illness waivers, those waivers can be triggered by the spouse, even if the spouse is not an owner of the contract. So in what we expected to be a DOL world, that's changed now, but at the same time, everyone's kind of geared towards that mentality. In what would have been a DOL world, you're looking at unqualified money where you're limited to a single owner. You've got nursing home and terminal illness waiver on here that can be triggered by the spouse, even if the spouse, they don't have to be a beneficiary or on the contract at all. And of course, they can't be an owner. So another value built into this contract, another flexibility should someone's circumstances change. Let's say they have an IRA that they're interested in growing, maybe getting some income on, but they have a spouse who's unhealthy. They want to be able to deal with that. We've got a mechanism for that, in particular on qualified money where you're limited on the ownership. The death benefit is the greater of the contract value or the minimum guaranteed surrender value if there have been distributions. This is a little housekeeping on actually submitting the business. We do need to receive paperwork within 14 days of the sign date. If there's cash, we need to receive the check with the application within 14 days of the sign date. That's 14 calendar days. If it's an exchange or transfer or rollover, we still need all the paperwork, including the transfer or exchange form, within 14 days. However, you get 60 days from the sign date for us to get those funds in and get the rates and caps that were in effect on the sign date. And again, additional purchases are allocated to a holding account, and then we'll apply them to the crediting strategies at the contract anniversary. So by my watch, we're 24 minutes into the presentation. I have gone very quickly. So I want to revisit the rider again and again touch a little bit on how you might use this in your practice. So one thing to think about, I've had a customer who he had a 7.2% roll up on one of his products. He had a customer who was already taking distributions, and this client started looking at the account value and decided that their performance wasn't very well because he hadn't thought about, number one, I'm taking distributions, and number two, what I'm paying for, well, the benefit I'm buying is this 7.2% roll up. So, you sell people on products, you explain to them how they work, and down the road, they forget, they change their minds, their circumstances change. With our product, we have a lot of levers you can pull to deal with that. With products that are built for deferral, 10 years, 15 years, that's a long time. And I think our product has a lot of benefits in a way for you to use it in your practice in a way that you can't with other products. This slide here was about the limited MVA, which we've discussed. And then actually what I was talking about here was a summary of the product highlights, and in particular about the rider. It is an attached rider. It's not an option. So if you're buying the product, you're buying it for the rider. And as far as positioning, I want to reiterate, we are strong at age 65 if you purchase it and turn income on right away. We're very strong at age 70 if with 10 years of deferral or 15 years of deferral, or at age 70 if you buy it and turn it on right away, you can get that 6% distribution. So those are going to be the spots where we're strong, and I would urge you to consider the flexibility and the uses of this product in addition to what you get on the income. You know, generally if let's say you're shopping for a car and you like a little bit of speed, does it mean that you immediately run out and you buy a Corvette? Or is speed just one of the things you're looking for? Well, we know that when you're shopping for a car, more often than not, even if you like some speed, you still got to have some storage space and maybe some gas mileage that you're looking at. So people tend to buy products that fill more than one need, that have some flexibility in them. They don't just go for the very max storage room and buy a flatbed. They don't go for the fastest thing they can find and buy a Corvette. They tend to buy something that has multiple features, and I would encourage you to look at our product that way, as a product that is flexible for you and your clients. And with that, I would like to open it up for questions if there are any.
Yeah, we do have a question here. Does the 1% fee, you might have covered this, but I think we should just reiterate, does the 1% fee come out of the benefit base?
It does not reduce the benefit base, no. It does come out of the account value. One interesting thing, though, with that, I mentioned the 1.25% on 100% of your premium. That math, when I mentioned that you could walk away with your premium after the surrender charges based on that 1.25% compounding. Functionally, what's happened in that case, we've kind of refunded them their fee. If they're walking away with their premium at 4 years and 7 months, despite the fact that we pulled the fee off of this contract for that time, they've had the coverage, they've chosen not to use it, but at the same time, they're walking away with their full premium at 4 years and 7 months.
Awesome, thank you. I don't have any other questions unless somebody else wants to. I don't see any others typed in there. That was the only one.
All right. Well, I went very quickly. It is a lot of information to get into a 30-minute. I want to make sure I respected everyone's time. Please, Core Group's been a great partner for us. This is a good product. It's got some great uses in your practice, and I would encourage you to please contact Alan or your relationship manager. Talk to how this might be a good benefit for your clients. And I appreciate you listening to Protective Life. Looking forward to hearing from you. Thank you very much.
Thanks, Mike, so much. Thank you, everybody. Enjoy your day, and I'll have the recording up on the website within an hour. Thank you.